How can you invest when markets feel expensive? The first thing that you can do when you're looking at markets and they're approaching or at all-time highs is to look at the facts. And one of the facts that we know is the stock market, when we talk about stock market, US stocks, is traditionally at all-time highs around 7% of the time over the past 75 years. So when we're looking at that, we have a lot of data that we can dissect, or we can say, how has the market performed here in the following 1, 3, and 5 years after the fact? Traditionally, we're investing in stocks. We're not putting money to work for 1 month or even 1 year. It is typically years down the road. What we see is that when you invest, putting money to work in the S&P 500, and the market is at all-time highs, traditionally speaking, over the past 75 years, you earn more than if you invest below all-time highs. And that's the case not just over a 1-year basis, but also a 3 and a 5-year basis. But when we're talking about investing at all-time highs in expensive markets, we're traditionally thinking about, look, markets feel expensive, the market's going to drop. And in all likelihood, the market will drop. We'll talk about that, what we've seen over here in the past year. But if you take a look at a market correction, so let's use round numbers. We invest in the S&P 500 at $100. What is the likelihood that a year later, that the S&P is at $90 or less? We see over a 1-year basis, about 10% of the time. When we go out to 3 years, that jumps down to 2%. And finally, over 5 years, there hasn't been a historical period where if you invested at all-time highs, that you would have lost money by investing in the S&P 500. So again, we can get a little bit of comfort here because we say, all right, we have a lot of years of data. We have decades of data. We have a lot of data points. We know that investing at all-time highs is very common, about 7% of the time. That's kind of what history teaches us. But specific to the market right now, what does it look like and what can I do about that? How can I look at the market on a go-forward basis? And again, we're not soothsayers. We don't know exactly what's going to happen in the market, but we're going to look at the facts and we can make decisions that would feel best for you and in your money. If we take a look at the market, one of the big factors we have to take into consideration right now is investing with rates being cut. I know that there's some concerns about interest and inflation out there. It's absolutely true. But if you look historically, when we have interest rate cuts and you see on a 1-year basis, you see that the stock market makes on average either 11 or 15%, depends on whether or not there's been a recession. You see that over the past year, there hasn't been the start of a recession. So we can say, all right, look, on average, we're up about 15%. Then over 3 years, you're up 48% and 97%. You have this tailwind of cutting interest rates. That's what's driving the market right now. That's a large factor to it. And so what we see is, okay, historically speaking, we'd expect to be up about 15%. What we saw over the past year, that the S&P 500 was up closer to about 17%. So right in line with that, a little bit higher, a little bit lower at times too, because remember we had the tariff tantrum that occurred here in the April period. But when we talked earlier and we were showing the data and saying, look, over a 1-year period, 10% of the time, you could be in that 10% pullback. That definitely did occur. In fact, we were close to having about a bear market here. But again, on a go-forward basis, we're looking at the 3-year basis and the 5-year basis of continuing high performance. And that's in part because, yes, we're at all-time highs. We also have interest rates being cut at the Federal Reserve over a longer period of time. And one other thing we really want to highlight here is we're talking about stocks being very expensive. We're talking about U.S. stocks, but not all stocks are at all-time highs. In fact, not all stocks are very expensive. We actually expand our sphere out to stocks in not just U.S. stocks, but we look at international stocks, which is the gray chart here, emerging market stocks. So think of like China, Brazil, India, Indonesia, Philippines. Those stocks are actually outperforming in this recent rate cut cycle that we're seeing here since the latter half of 2024. We're seeing strong performance across the board. And what we would leave on is this. There will always be a reason to sell. This is a great chart that's put out by Ritholtz Wealth Management. What they do is they said, look, since 2009, there's always been headline risk. There's always been reasons for why we would look to sell, whether that's the Ebola virus or we had the European credit crunch. We've had the yen trade was the last thing that they kind of highlighted here in 2023. Multiple wars that have occurred. There's always been reasons to sell. Those reasons to sell are what happens when you open up the paper. That's why it's so important for you to think about, okay, look, I know what I'm seeing. I know what the facts are. I know what's being reported, but I also know, historically speaking, here's how stocks have performed when they feel expensive. When it feels like there's a reason to sell, we looked at, historically speaking, just because stocks are expensive, that doesn't mean that they can get quote unquote more expensive. In fact, a way to look at it is to say that when stocks are expensive, it's telling you that people are saying that we like what we're seeing in the fundamentals of the companies and the stock market itself. Thank you so much.